We're talking about investing in the stock market. Sounds a little intimidating? No worries, that's why we're here. Welcome, future millionaires, to Investing Lighthouse, where we break down the world of investing into bite-sized pieces and help you get a firm grip on your finances. Step number 1. Set clear investment goals. Just like you can't embark on a cross-country road trip without a destination, you can't start investing without setting clear financial goals. Think of your investment journey like a GPS. You need to know where you're headed to get to the right directions. Are you saving for a down payment on a house? Funding your startup dream? Planning for early retirement? Your investment decisions will be guided by the answers to these questions. For instance, if you're saving for a house in 5 years, you'll likely opt for lower risk investments compared to someone saving for retirement in 30 years. Step number 2. Understand your risk tolerance. Investing is like going on a roller coaster ride. There are ups, downs, and occasionally some pretty scary loops. Your risk tolerance is how well you handle those stomach-churning loops. It's influenced by factors like your financial situation, investment goals, and personality. Are you a thrill seeker willing to take on higher risk for potentially higher returns? Or do you prefer a smooth ride, prioritizing capital preservation even if it potentially means lower returns? Knowing this can help you create an investment portfolio that won't keep you awake at night. Step number 3. Build an emergency fund. Before diving into investing, ensure you've built up an emergency fund, typically covering 3 to 6 months worth of living expenses. Think of this as your financial life jacket. If unexpected events like job loss or medical emergencies occur, you'll stay afloat without needing to sell your investments prematurely. Imagine being forced to sell stocks during a market downturn because you need the cash. Definitely not an ideal scenario. Step number 4. Educate yourself. Remember when your high school teacher said knowledge is power? It couldn't be more accurate in the world of investing. The stock market is a complex beast, and understanding its intricacies can significantly improve your investing outcomes. Read books, watch financial news, join online forums, and take advantage of our video library. The more you learn, the more confident you'll be in making intelligent investment decisions. For instance, understanding key concepts like diversification and dollar cost averaging can significantly enhance your investing strategy. Step number 5. Choose an investment account. Once you've gained some financial knowledge, it's time to choose an investment account. This could be a regular brokerage account or a tax-advantaged account, similar to an individual retirement account, IRA, or a 401k, if you're in the United States. If you're in the UK, you might consider a stocks and shares ISA or a pension. The best choice depends on your circumstances and goals. A 25-year-old freelancer might opt for a Roth IRA for its tax-free growth and withdrawal benefits, while a 35-year-old employee might go for a 401k to take advantage of employer-matched contributions. On the other hand, a brokerage account offers you the versatility to invest in a broad array of securities and withdraw your money at any time without penalty. Step number 6. Decide your investment strategy. Your investment strategy is your game plan. Are you a passive investor who prefers investing in index funds or ETFs that track a specific market index? Or are you an active investor who likes selecting individual stocks and looking for gems? Both strategies have their pros and cons. Passive investing, for example, generally involves lower fees and less time commitment, but you'll never beat the market as you're mimicking it. Active investing could potentially yield higher returns, but requires more skill, time, and sometimes higher fees. Step number 7. Diversify your portfolio. Diversification isn't just a buzzword. It's your shield against market volatility. By spreading your investments across diverse asset classes and sectors, you'll reduce the risk of your entire portfolio plummeting if a single stock or sector takes a hit. Consider this. If you had invested all your money in technology stocks in the late 90s before the dot-com crash, you would have faced significant losses. But if you spread your investments across tech, health, utilities, and other sectors, your losses would have been less severe. Step number 8. Start investing. You've laid the groundwork. Now, it's time for action. Start by investing in companies or sectors you understand and believe in. Don't let emotions guide your decisions and invest based on solid research. Imagine investing in a technology company like Apple just because you love their products. It's not wrong, but it's also not enough. It would be best to look at Apple's financial health, its growth prospects, how it fares against competitors, and whether its stock price is fair. That's informed investing. As a young investor, you might be particularly interested in companies that align with your values. You could consider investing in ESG, or environmental, social, and governance, stocks or funds, which prioritize companies with strong environmental policies, social responsibility, and transparent governance. Step number 9. Keep emotions in check. The stock market is similar to a roller coaster, and getting swept up in the excitement or panic is easy. But remember, successful investing is about logic, not emotion. Resist the urge to buy high out of greed or sell low out of fear. Stick to your investment plan, even when things seem uncertain. Warren Buffett, one of the greatest investors of all time, says it best: be fearful when others are greedy, and greedy when others are fearful. Step number 10. Regularly review your portfolio. Lastly, investing is not a set-and-forget activity. Treat your investment portfolio like a garden. It needs regular tending to thrive. Review your portfolio periodically to ensure it's still aligned with your goals and risk tolerance. If necessary, rebalance your portfolio by buying or selling assets to maintain your desired asset allocation. Imagine you bought shares in a promising tech startup, but over time, the company's management has made questionable decisions, and its growth has slowed. Keeping tabs on such changes can help you make timely decisions to protect and grow your wealth. Congratulations! You're now equipped with a roadmap to start your investment journey. Remember, investing isn't a sprint but a marathon. Patience, consistency, and a willingness to learn are your best friends on this journey. Ready to take the plunge? Go forth and invest, future millionaires! Go ahead and like, comment, and share this video with friends who could benefit from this knowledge. And of course, don't forget to subscribe to stay updated on our latest videos. Here's to growing our wealth together. Cheers!